If you look at the headlines today, April 29th, 2026, you'd really think the global economy was just bracing for impact. I mean, collapsing ceasefires, rockets flying, geopolitical shocks coming basically one after another.
Right, and based on conventional wisdom, you would absolutely expect chaos on the trading floor, like a total flight to safety.
Exactly. But then you look at the screen, the Nasdaq Q, the S&P 500, the DAX in Germany, the Nikkei in Japan, they're doing something they almost never do right now.
Yeah, printing consecutive vertical green candles, just marching relentlessly higher.
It's like flying in a commercial jet on autopilot.
Yeah.
The passengers are, watching a terrifying thunderstorm out the window, completely panicking.
But the plane's computer just doesn't care about the lightning.
Right. It's blindly following its pre-programmed coordinates. The market isn't just ignoring reality right now. It's actively defying it.
And that defiance is precisely what sets up the kind of deceptively calm environment that severely punishes anyone who doesn't understand the underlying mechanics.
Because when the market stops reacting to the news, it means a completely different set of rules has taken the wheel.
Exactly.
Which is exactly what this deep dive is going to dissect today. So whether you are prepping for a major portfolio strategy meeting, or you manage your own capital, or you're just insanely curious about why financial markets are totally divorced from the real world right now, this is designed specifically for you.
For sure.
Okay, so let's unpack this. We are pulling from a highly detailed, incredibly prescient market situation report today. It's titled AI Bubble Acceleration.
Authored by analysts Finek and Miet Khosravi.
Yes. And the core mission for us today is to uncover the invisible structural mechanics driving this massive rally. And, well, more importantly, figure out how to survive the traps that are being set right in front of us.
Because the simple truth here is that the market algorithms have essentially detached from the news cycle. I mean, they are no longer parsing geopolitical headlines to decide whether to buy or sell.
They're just hunting for liquidity.
Yes. Running purely on structural inefficiencies, regardless of what the front page of the newspaper actually says.
And the ultimate proof of that, according to the report at least, is happening right now on the triple Qs.
Ah, right. The QQQ ETF that tracks the Nasdaq Q.
Yeah. They have just printed 9 consecutive bullish two-day candles. I mean, that is 9 periods of uninterrupted upward movement.
What's fascinating here is that to the untrained eye, vertical price action just looks like unshakable strength.
Or absolutely. You see 9 green candles stacked vertically, 3 groups of 3 with no meaningful pause, and the emotional response is just, well, this is a rocket ship. I need to get on board before it leaves me behind.
Right. But historically, this specific 9-candle stacked formation is incredibly rare, and honestly, it's a massive red flag.
It makes sense if you think about it like a sprinter holding their breath.
Yeah.
You can run incredibly fast for a short burst, pushing your limits, but eventually your biological mechanics demand oxygen.
You have to exhale before you can keep running.
Exactly. If you try to force it, you pass out.
Yeah.
So the market is basically holding its breath right now.
That is a highly accurate way to visualize it, because the algorithmic mechanic is remarkably consistent when we see this 9-candle setup.
It resolves with a shakeout, right?
Almost always. That vertical signature resolves with a sharp, localized shakeout. It's a deliberate algorithmic sweep.
Okay.
The systems are literally programmed to trigger a rapid drop to clear out the latecomers.
Meaning the retail traders who bought at the absolute top, thinking it would never end.
Exactly. It clears them out before the market gathers the liquidity it needs to take its next leg higher.
Hold on, though. If this is a known algorithmic sweep-like, if the Khosravis know it and institutional players know it, why doesn't the rest of the market just front-run it? Why isn't everyone selling today to beat the algorithms to the punch?
Well, because the emotional pull of missing out is usually stronger than the logic of market mechanics for most retail participants.
Right, the FOMO is just too real.
It really is. Plus, the specific timing is perfectly designed to trap them. The algorithms wait for peak exuberance. Which actually brings us to the calendar date.
April 29th, 2026. This is a massive corporate event window.
Huge. 4 of the most important companies on the planet, Microsoft, Amazon, Meta, and Google, they all report earnings today.
So the trap is just perfectly baited. I mean, the retail mindset says these are the AI titans. If Microsoft crushes earnings today, the stock goes up. That's just basic math.
In a standard linear market, maybe, but the Khosravi report explicitly warns that this is a trap right now.
Wait, even if they post blowout numbers?
Even if they post absolute blowout numbers, record revenues, incredible forward guidance, there is still an 80 to 100% probability of a mechanical pullback here.
Okay, so what does this all mean? Let's break that down for the listener because this is where that invisible architecture really comes into play. If the news is spectacular, why is a drop practically guaranteed?
To understand why, we have to look at the anatomy of a monthly trading candle. So think of the time frame of an entire month.
Okay.
The final few days, which is exactly where we are right now, typically form what we call an upper wick on the chart.
And this happens because major institutional firms are rotating their profits, right?
Exactly. They aren't selling because they hate the stock. They're selling because their internal risk mandates require them to balance their books.
They have to lock in gains before the month officially closes.
Right. They report to their clients based on these monthly metrics. They've ridden the wave up, and they legally or procedurally just have to take some chips off the table.
So you have this massive structural sell pressure hitting the market, completely independent of how good the earnings report actually is.
Yes. And then the first week or two of the new month forms a lower wick. This is that algorithmic stop run we just talked about.
So the algorithms sense the structural selling from the big funds,
Yeah.
and they essentially accelerate it downward.
Exactly that. This dip triggers the stop losses of all the late retail buyers who bought the top. Yeah, the algorithms gather up all those forced sell orders to get the liquidity they need, and then they prepare for the expansion phase that resumes mid-month.
The report gives a pretty brilliant historical analog to prove this isn't just theory, too. JP Morgan.
Oh yeah, that's a perfect example. They recently posted arguably their best ever earnings.
Right, and based on the fundamental data, analysts fully expected the stock to rally like 5% instantly.
But instead, the stock just drifted sideways and eventually dropped to form an upper wick. The fundamental news was pristine. The business was thriving.
But the structural mechanics dictated a profit-taking rotation.
Exactly. The sheer volume of institutional capital rebalancing simply overrides the earnings excitement.
I want to make sure you, listening right now, really catch this crucial distinction. The expected drop this week isn't because the AI companies are failing.
Or because the technology is a fraud or the bubble is suddenly popping.
Right. It is a cold, mechanical reality of how massive capital rotates at the end of a month.
It's literally a structural feature of bull markets. The retracement between the top of one monthly candle and the bottom of the next is not a reversal signal.
It's an exhalation, like the sprinter catching their breath.
Exactly.
So, okay, if these algorithmic sweeps are as predictable as gravity, and we know this late-month liquidity hunt is going to drag the market down temporarily, does that mean the overarching bull run is just dead? Should we be packing up our bags entirely?
Not even close. If we zoom out and connect this short-term trap to the bigger picture, the higher time frame architecture is aggressively bullish.
Right. The analysts point out that the Nasdaq Q is currently printing what they call a double inside 2-month candle breakout.
Yes.
Let's freeze right there. Double inside 2-month candle breakout. For anyone picturing an actual wax candle on their dining table, what does an inside candle actually mean on a chart? And why does a double one act as such a powerful signal?
Think of an inside candle like a coiled spring. On a chart, a candle represents the highest and lowest price an asset reached during a specific time frame.
Okay, so an inside candle means the entire price movement for that period stayed completely within the high and the low of the previous period.
Precisely. It didn't make a new high, it didn't make a new low, it just consolidated.
So the market is winding up, it's compressing.
Exactly. Now, imagine that happening on a 2-month time frame. And then imagine it happening twice in a row.
Wow, so that is 4 solid months of massive macro-level price compression.
The energy is building, but it isn't releasing.
Okay.
When it finally snaps upward and breaks out of that tight range, which the Nasdaq Q is doing right now, it creates an incredibly powerful foundational floor.
It's a really rare structure. The report noted that the last 2 times it printed cleanly on the macro charts, it acted as an ironclad support base for an entire multi-year bull cycle.
It is ironclad. So when the Nasdaq Q closes this period as a bullish engulfing pattern, meaning the new upward movement completely overshadows the previous compression, it locks in a safety net.
Meaning future drawdowns might drop, but they are highly likely to bounce off this hardened floor rather than just crashing right through it.
Exactly. And we are seeing global cross-asset confirmation to back up just how strong that floor is.
Right. The Nikkei in Japan is targeting an all-time high of 62,596 based on a very similar massive structural pattern.
But you know what asset really caught my eye in this section of the report?
Bitcoin.
Yes. specifically looking at IBIT, which is BlackRock's spot Bitcoin ETF. It serves as a great proxy for institutional money.
Because while tech is going completely vertical and getting literally all the attention, Bitcoin is quietly coiling inside a higher base.
Right, leveraged long positions that entered down around 71K are currently targeting 93K.
Which brings us to this concept of cross-asset rhythms, right? Like
Yeah.
markets don't all move at the exact same millisecond.
Exactly. The Nasdaq has been leading the charge, absorbing the initial waste of capital, but Bitcoin is following the exact same structural rhythm, just with a slight lag.
If you look at the IBIT chart, the analysts actually highlight an open inefficiency sitting roughly 6% above its current price.
Right, an unfilled gap.
What exactly is an open inefficiency in this context? Is that literally just a blank space on the chart where the price skipped over?
In essence, yes. During periods of high volatility, the price can jump from one level to another so quickly that no trading actually occurs in the space between.
Oh, I see.
So algorithms view these gaps as unauctioned price levels, basically unfinished business. Once the overarching market establishes that a breakout is real, the algorithmic intent almost always shifts to hunting down and filling those open inefficiencies above.
Which reveals this incredible psychological irony happening right now. I mean, retail engagement in crypto is sitting near all-time lows. Why?
Because everyone is staring at AI.
Exactly. The retail crowd is entirely distracted by ChatGPT updates and NVIDIA headlines. Meanwhile, smart institutional capital is quietly accumulating crypto right before the algorithms inevitably push up to fill that open gap.
It's a textbook contrarian setup. The noise is in one sector, but the quiet accumulation is in another.
It really highlights a recurring theme we see over and over. When nobody's paying attention, the patient buyer wins.
Always.
Which leads us directly to the practical application of all this. We know a massive macro bull run is supported by these ironclad, compressed structures.
But we also know a sharp short-term dip is practically guaranteed because of the monthly close and those algorithmic stop runs.
Right, so how do the Khazravis suggest we actually play defense without missing the overarching run? Because sitting on our hands just feels reckless.
Well, the primary mandate from the report is quite clear. You do not liquidate your portfolio.
Okay, so don't sell everything in a panic.
Exactly. The strategy is to maintain your long swing positions. For instance, if you hold Amazon, which the report notes is riding an ascending triangle breakout targeting 350.
Or if you hold spot Bitcoin.
Right, you hold it. You don't try to perfectly time the top and buy back in. Instead, you deploy highly specific tactical hedges.
And the report gives a very precise, actionable playbook for this. It advises buying QQQ $650 strike put options expiring on May 8th.
Yes, and at the time of the report, they were trading around $5.95 per contract.
Which is super specific. But we really have to stress, for you listening, this is not a bearish bet against the market.
Not at all. You aren't hoping the economy crashes. This is purely tactical portfolio insurance. The Khazravis advise sizing this hedge at just 0.5% to 1.8% of your total portfolio.
I actually need to stop you there, because to a lot of listeners, the math on this hedge sounds a little bit like alchemy.
How so?
Well, the report claims that if the market drops just 2% to fill the gap sitting below on the chart, those specific put options can return 120 to 140%. How does a tiny 2% dip translate to a massive triple-digit gain? Like, explain the mechanics there.
Right. It comes down to the nonlinear way options are priced, specifically something called gamma.
Gamma, okay.
Because these put options are slightly out of the money, meaning the market hasn't dropped to the $650 level yet, they are relatively cheap to buy.
Right, because the event hasn't happened.
Exactly. But as the market price drops and rapidly approaches that $650 strike price, the algorithm that prices the options aggressively marks up their value. It's exponential, not linear.
So a very small, sudden downward movement in the underlying QQQ ETF creates an explosive upward movement in the value of the put option.
You got it.
It's essentially like buying flood insurance. When the weatherman says there's a 90% chance of a flash flood tomorrow, you don't sell your house and move to the desert.
Right. You don't
cancel your life. You just spend a tiny fraction of your net worth on an insurance policy. If the flood hits, the insurance payout completely covers the water damage to your living room, basically neutralizing the loss.
That analogy hits the nail on the head perfectly. That isolated 140% profit on the puts completely neutralizes the short-term drawdown of your core long holdings like Amazon or Bitcoin.
And if the market defies the odds and the flood never comes?
Well, those options just expire worthless. You're out a few bucks for the premium, but your massive core portfolio continues to compound in the sunshine.
I see the logic there. You buy the peace of mind, so you don't panic sell your main investments during a perfectly normal structural pullback.
Exactly.
Okay, so we've packed the umbrella, we've hedged the short-term turbulence. Now the conversation drives toward the absolute climax of this report. Because with all this capital flowing and these multi-month compressions breaking out, where is the absolute peak of this compounding? Like, where is the center of gravity for this entire bubble?
The real bubble isn't spread evenly across generic tech. It is highly isolated, and it's heavily concentrated in the hardware, the chip sector.
Here's where it gets really interesting. Look at AMD. The report points out that AMD has just printed the largest quarterly candle in its entire company history.
It's wild. One single week of trading delivered a 30% return.
Let's contextualize that to see why it matters.
Right.
Historically, before the AI narrative took over, AMD rarely posted more than a 10 to 12% return across an entire 3-month quarter.
Right.
And they just did 30% in 5 business days.
To put AMD's 30% weekly candle in perspective, that is essentially a full year's worth of traditional S&P 500 returns compressed into one single week.
It's unbelievable.
The aha moment here is realizing that applying traditional valuation metrics to a parabolic regime is like trying to measure the speed of light with a wooden ruler. The old math is entirely broken.
The line on the chart literally goes completely vertical, and it's not just AMD.
No, it's systemic across the subsector. NVIDIA hasn't even hit its true parabolic phase yet.
Wait, really? NVIDIA's still warming up?
According to the structural charts, yes. It is just warming up for a major all-time high break. And we are seeing Broadcom, AVGO, and SoftBank surging in absolute confirmation.
This is the unambiguous, undeniable signature of generational capital inflow.
Absolutely.
Which raises an incredibly dangerous dilemma for traders. When you see a chart go straight up, human nature screams, "This is too high, it has to crash, I should short it. It feels like gravity has to kick in."
And that instinct is exactly how traders destroy their accounts. The golden rule that Kasravis emphasized for this environment is this: you must refuse to short prematurely.
Shorting a true parabola is the most expensive mistake you can make in financial markets.
Without a doubt. A market breaking out of a massive multi-month consolidation doesn't just stop the second it hits an all-time high, it extends.
Because the people who do try to short it end up getting margin called, and their forced buying just fuels the rocket even higher.
Precisely. If you look at historical precedents like the 2017 and 2021 crypto climaxes, or Microsoft's vertical move in November 2021, these parabolic phases can stretch far beyond logical valuation.
So the chip sector could potentially have another 100% of upside before the cycle actually reaches mechanical exhaustion.
Easily. These phases are where generational wealth is created, provided you don't step in front of the train.
The scale of this expansion is just staggering, and it reinforces the central takeaway for you listening right now. You have to recognize the regime you are operating in.
We are no longer in a market of standard, linear, predictable growth.
It is exponential. The transition from crypto holding the world-changing mantle back in 2021 to AI holding it now represents a massive generational shift in global capital allocation.
And navigating it requires immense patience, emotional discipline, and the willingness to hold your core positions through those inevitable algorithmically driven short-term shakeouts we detailed earlier.
Exactly. So let's look at the journey we've just taken. We started by understanding that the market's defiance of loud, terrifying geopolitical news isn't blind luck.
It's algorithmic detachment.
We recognize the mechanical traps of late-month earnings, why institutions rotate profits, and how algorithms hunt for stop-loss liquidity, creating those upper and lower wicks.
We looked at the necessity of deploying smart money hedges.
Right, buying cheap out of the money puts to act as flood insurance. And ultimately, we learned to respect the generational, parabolic reality of the chip sector, where old valuation math no longer applies.
Understanding these invisible architectures fundamentally changes how you view your investments.
It completely shifts you from nervously reacting to every screaming headline to actually anticipating the structural flows of capital before they happen.
And, as we sit here watching these trading algorithms perfectly execute structural chart mechanics, efficiently hunting liquidity and completely overriding real-world geopolitical events, it leaves us with something quite profound and maybe a bit unsettling to consider.
What's that?
Well, if today's relatively basic market algorithms are already powerful enough to completely ignore human news cycles and run entirely on structural mechanics, what happens to the global economy when the very AI technology being pumped in this massive parabolic chip bubble begins writing its own infinitely more advanced trading algorithms?
Wow. Are we currently funding the creation of an entirely post-human financial market where human traders aren't just outmatched, but completely obsolete?
It's definitely something to think about.